Greetings traders, and welcome back to another survival guide. Chris here, bringing you some more information that will hopefully give you some competitive edge one day to pass your Gauntlet experience. As far as today's discussion, we'll be talking about 8 different trading styles or strategies, so to speak, that are commonly found in the trading world by successful traders. These are 8 different ways to go about your market experience. If you're a beginning trader, this stuff is valuable to listen to because you'll then have more directions that you can choose to head in. Ultimately, the choice is yours. But if you don't know something exists, or if you don't know something is a logical idea, how can you ever know to pursue it? And for those of us that are experienced traders, this information can be valuable because perhaps we're not satisfied where we're at and we want to explore different areas. But without further ado, let's go ahead and dive on into that material and learn about a few different trading profiles that we can choose from. Because the financial markets are multifaceted and just a world of just diverse opportunities, it is important to first address the question of which type and which style of trading speaks to you. As we work our way into the different options and the different categories we can choose from, we're met with the first category, which are the trading styles that are dictated by the time frame. The time frame of which the trades apply to kind of give this style its name. And of this, the first category everyone has heard of, or most everybody, I hope, is day trader. A day trader with a straighter line looks nicer. So the day trader is somebody that is focused on exploiting trading opportunities without leaving positions open overnight. Alternatively, their trades are opened and closed within a single trading session. That's the general concept. Open and close within the day. Hence the name, the day trader. The average open time of a day trader's position is usually less than an hour, and these trades might remain open for a couple of hours. It is still possible to do this. However, it's far more common day traders are only keeping their positions open for 1 to 2 hours at max. And day traders themselves, they usually prefer more liquid instruments like stocks, forex, and futures because it allows them to get in and out of their trade whenever they want, of course. And day trading, of course, is a risky activity, as all trading is going to be, because it does usually rely on large amounts of leverage. At least the day trading aspect of trading tends to. It is possible to begin day trading with a bit less, and we've actually talked about that in the past. But next, let's move on to the swing trader. The swing trader, this is someone that is using a trading style that's aiming to capture short and medium term gains over an extended amount of time. It's usually considered to be one of the more popular forms of trading, and swing traders are usually looking for those medium-term opportunities with technical analysis. They're usually holding their positions open for a couple days or even up to a couple weeks to get to the profit levels that they're looking for. So where the day trader was someone holding the position open and close within a single day, the swing trader is someone that's usually going to have their position open for a few days to a few weeks. The most successful swing traders usually are aiming to capture just a part of an expected move, hence the reason they're not holding for the longer term, which we'll get to in just a minute. That brings us to the position trader. The position trader is someone who buys assets of which they feel are valuable in the long term. As a result, their strategies aren't usually too concerned about short-term price fluctuations because instead, they're focusing on the macro trend and the growth potential of whatever asset that they're buying. Position traders are usually trend followers. They want to identify a trend, open a position, and keep hold of it until the market movement has reached a relative peak and changed a different direction. If we were to compare position trading with day trading, we can say that the number of trades that the position trader places per day often will be far, far less than the number of trades that a day trader would take. And with that being considered, the number of trades that a day trader takes in a single day oftentimes will exceed the number of trades that a position trader will take in an entire month. This doesn't mean that this is the only way that these things can be done, but this is just characteristic. And next we have the scalp trader. The scalp trader is another one that many people are familiar with. A scalper is the epitome of a short-term trader. They're looking to take advantage of price discrepancies. They're looking to take advantage of micro movements in the market, and sometimes are getting in and out of the trade within a matter of seconds. They're not holding trades for hours. They're looking to take advantage of something here and now as far as both the entry and the exit. And then next we have the intraday trader. The intraday trader is another term that's used for day trading, so this one connects back to our day trader. The word intraday basically means within one day, and in many cases both terms here, intraday trader and day trader, are oftentimes interchangeable. So if you do find yourself that you're confused about what an intraday versus a day trader is, it's really not all that different. The only minor differences that you could really encounter in your searches for this type of information is the fact that an intraday trading style might be a little bit more frequent and has a shorter open time for each trade because it's focusing on almost a faster variation of day trading, but still, once again, pretty much the same thing here. The first 5 trader types that we discussed were all categorized based on the time and length of the trades that the trader takes. These next 3 are coming from the types of tools that the trader is using to garnish their information about the market and what they're using to gain their insight. The first that we have is the fundamental trader. The fundamental trader is someone that is looking to evaluate an asset to get a realistic estimation of the intrinsic value of something. To do this, they are usually studying all types of information, including macro and micro trends. Generally, though, they put the main emphasis on the individual performance and inherent characteristics of the asset. In the case of stocks, for example, the fundamental trader will focus on measuring the financial strength and management of a particular company. And to do that, they might rely on financial statements, they might look at some historical data, take a look at some investor call conferences, maybe some press releases. All of these are representative of what a fundamental trader might take a look at to try to get a better insight into where something might be going or what something is truly worth, and take a look at how price relates to what they feel it's actually worth. Then we have the technical trader. The technical trader differs from the fundamental trading style because it aims to identify opportunities by using indicators to generate some type of trading signal. As a result, other than just using the information from an earnings report, a technical trader is going to analyze the exact trajectory of path, or the exact trajectory of price itself, not just the path of the company. And the technical trader usually believes that the fundamentals are factored in to the technical information. So a lot of technical traders feel that they are inherently abiding by a lot of the same information that maybe a fundamental trader might be using, even though there's a pretty strong divide here. Then beyond that, we have a further categorization that we should talk about called the price action trader, which really technically falls under the technical trader tree. That's because a price action trader, which is arguably the most popular corner of the technical trading style, is someone that specializes in plotting the price movement of a specific asset over a certain period and are looking to analyze those price movements based on how those occurred and how price responded to those movements in the past. This is somebody that is using their Japanese candlestick analysis or taking a look at particular support and resistance levels. This is one of my favorite styles of trading, and it is what I personally love, but that doesn't mean it has to be yours. Which brings us to the next point. How do we know which style to pick? Well, it's a very personal question, and the best thing that I can recommend is ask yourself some of these questions. The first being, are you a beginner or do you have some experience? This is important because if you're looking to trade and you don't know much, Generally, the consensus is the longer the time period of your trade, meaning closer to that position trader, the easier your trading will be than if you were to shrink that trading down, increase the volume, and try to analyze exact tops and bottoms in a small trend. Then you have, what instruments would you like to trade? This is an important question to ask as well. Perhaps you like trading something that's not liquid. If you want to trade something that's not liquid, then day trading is not for you. Next, you should ask, are you able to stick to a plan and control your emotions? Regardless of which style you choose, this is something that you do need to ask yourself and need to understand is crucially important to be successful regardless of the path. And next we have, how risk averse are you? If you are very risk averse, generally you're going to prefer more longer term holding versus shorter term ins and outs with leverage. Next you have, would you prefer chasing big one-off profits or building your wealth gradually? This essentially kind of gets a roundabout way to see how you feel about long-term trading to short-term trading. If you want to monitor the market, that's another question you need to ask yourself. If you want to monitor the market more or less, that's also going to help you decide which trading style is right for you. If you wanted monitor the market more, then you're going to want a trading style like a shorter time frame trading style where you're going to constantly need to pay attention to those times. Or if you want to monitor less and you want less work involved, then you're going to want to be more of a longer term trader who has to look less often at the charts and isn't closing positions out within a single day. These are all questions that are very valuable to be aware of, and I strongly encourage you to go through this process and think about what your specific answer might be. Now that we've covered all of the different categories that you can fall into as a trader, it's up to you to determine which one fits you best. The only right and wrong answer in this category is picking one that doesn't suit you. If you pick that one, that's the wrong one for you. It is up to you to continue to try out the different trading styles, use a demo account of course, and see which one feels more natural, which one excites you the right amount while allows you to achieve the highest rate of success. But until next time, folks, if you haven't already, please do me a huge favor. If you're still here, click the like and subscribe button down below to let me keep coming out with content for all of you out there. I will see you all very soon. Cheers, everybody. Good luck in the markets. Over and out.